So interesting thing, Fidelity in a marketing gimmick, or you could say a clever business move, has 4 mutual funds that are all priced at 0% expense ratio. So they're entirely free to hold. Um, I think it's a marketing gimmick because, as we see with mutual funds like Schwab's S&P 500 index, which charges 2%, 2 basis points, and Fidelity's mutual fund that tracks the S&P 500, which charges 1.5 basis points. The returns that are eaten away by the expense ratio is near zero. Um, here the adjusted expense ratio is the expense ratio. Same with SWPPX, and I just updated to the latest OS and the computer is running slow. That's kind of unfortunate, and I guess you could call this planned obsolescence from Apple. Anyway, so of these 4, I think they're all marketing gimmicks. I think this large cap index, FNILX, you'd be better off sticking with an S&P 500 because S&P 500 is the 500 largest companies. So that's essentially the same thing. Extended market is basically the S&P 400 plus S&P 600, and the S&P 400 is the 400 stocks that would come after the S&P 500, and the S&P 600 would be the 600 stocks that would come after the S&P 500 and S&P 400. So this is Fidelity's version of that. I don't know the exact composition. I looked into this a couple days ago, but it was late, so I didn't make any a video about it. But here, I think you'd be better off buying the S&P 500 still. If you wanted small cap exposure, I think you could go with like a IWM, which I believe is Russell Small Cap. Is that right? I'm pretty. If it's not right, there are lots of small cap funds, um, or you could stick with like a VTI, which is Vanguard's total stock market index fund. Uh, sorry, yeah, that's right. For the total market index fund, FZROX, I think you would be better if you bought Vanguard's total index fund, total market index fund, or the S&P 500. I know I keep saying S&P 500, but honestly, I think unless you really want to do your due diligence, it's a lot of effort to choose your own stocks. And indexing, I think, is the right route for almost everybody. And that's a route I'm trying to take a little bit more of after having the last couple years pretty actively choosing my own companies. However, however, notice I said lastly when I was talking about this, I believe Fidelity's Zero International Index Fund, FZILX, is actually a banger of a deal. This is a really good deal. There is 0% expense ratio, as with the other 3. But if you compare this to if you compare this to its equivalent at Vanguard, which would be the Vanguard Total International Fund, the expense ratio on that is much higher than it is on Fidelity's. Of course, Fidelity charges 0, so anything is going to be higher than 0. But the expense ratio here is 7 basis points, which is extremely low on an absolute basis when compared to the decades of active mutual fund management we've had in the past. But compared to Fidelity's S&P index fund or Vanguard's total stock market index fund, which just tracks the entirety of the US market, which charges, I don't know, like 3-4 basis points. This is actually pretty high. And the reason why I think that this that Fidelity's FZILX is as good as the Vanguard Total International Stock Fund is because their underlying holdings are very similar. And in fact, I think this is Vanguard's, yeah, that's right, are very similar, and the return profiles are also pretty similar. So we'll just compare them side by side here. So you got TSM as the highest weighting, okay? Nestle, followed by Roche and Tencent. Here it's followed by Tencent and Samsung. ASML is here, Roche, which is number 2 here, Toyota, Shell, AstraZeneca, BHP, which is, I believe that's a Brazilian company in the mining space. Their competitors, biggest competitors, Vale, I believe. Might have to double check on that. And then here, Toyota, no AstraZeneca, but there's Novartis. Here, no Shell and no BHP, but we have LVMH and Alibaba. But let's go to next page and see if we do any catch up. Here's Alibaba, Novartis, LVMH, Novo Nordisk, RBC, TD, HSBC, Commonwealth Bank of Australia, Sony, AIA, here AstraZeneca, Novo Nordisk, RBC, TD, HSBC, Unilever, Sony, Total, AIA, SAP. So you see there's so much overlap between these. The Vanguard's is definitely more diversified, although although I'm not sure how the ETF methodology is exactly, but there's probably some degree of sampling in both of these, which means that they don't actually track the underlying components that the index of the index that they're tracking. Instead, they pick like a good majority of the stocks, definitely the ones in the top 10, top 20, top 50, and then they use some smart mathematical optimizations to only need to choose some of the smaller caps. So I don't actually know how big of a impact having close to 8,000 holdings is when there's already 2,000. But turnover is the exact same, and percent of assets in the top 10 holdings. Here it's 13% versus 9%, so it's a little more concentrated in the Fidelity index fund or mutual fund. But all in all, I think the two of these have extremely similar performance. And in fact, I believe the thumbnail of this video will become will be their prices side to side. And with that, I just wanted to showcase this, and I do plan on continue making these types of videos going forward. So with that, if you would like to see more of these, please subscribe and like the video if you would like. Other than that, I am going to the Berkshire annual meeting tomorrow, and today's Thursday. The meeting is not until Saturday, but I'm flying to Omaha tomorrow. And yeah, it's stock market's very turbulent these days, but for those of us, we are all hopefully invested in for the long term. So with that being said, hope everyone has a nice night.